Ladies and gentlemen, when I look at markets, I don't start with opinions. I start with patterns. Cause and effect, debt cycles, human psychology repeating itself over and over again, just with different instruments and different narratives. Today, I want to talk about silver, not as a metal, but as a signal. Because silver is setting a trap. Throughout history, whenever there is late cycle behavior, investors search for safety and opportunity at the same time. They want protection from currency debasement, inflation, and geopolitical uncertainty, but they also want upside. Silver often appears to offer both. Markets don't move because people have strong opinions. They move because underlying forces push them in predictable patterns over time. When I study markets, I'm not trying to guess what will happen next week or next month. I'm trying to understand where we are in the cycle and what typically happens next when similar conditions have existed in the past. This way of thinking is critical because most investors lose money not because they lack intelligence, but because they misunderstand how cycles work. Every economy operates in repeating cycles, short-term business cycles and long-term debt cycles. In the early part of a cycle, credit is cheap, growth accelerates, optimism rises, and risk-taking increases. As success builds on success, borrowing expands faster than income, asset prices rise, leverage increases, and people begin to extrapolate recent gains far into the future. This is when narratives become powerful. Stories start replacing data. Confidence turns into complacency. Silver, like many assets, becomes attractive at this stage not because of fundamentals alone, but because of the story surrounding it. People believe they are early, that the opportunity is obvious, and that risk is limited. But markets punish what feels obvious late in the cycle. When too many people crowd into the same idea for the same reason, future returns shrink and risk quietly grows. Cause and effect always win in the end. When debt levels are high, central banks face difficult trade-offs. They either keep liquidity flowing and risk inflation, or they tighten policy and risk slowing growth. Both paths change how assets behave. This is why understanding cycles matters more than predicting headlines. By the time something is widely discussed, it is usually already priced in. Human psychology amplifies these cycles. When prices rise, people feel safer, even though risk is actually increasing. When prices fall, fear takes over, even when long-term opportunities may be improving. This emotional pattern repeats generation after generation. Technology changes, instruments change, but behavior stays remarkably consistent. That's why studying history is so valuable. It shows us how little truly changes. Silver sits at an intersection of these forces. Investors often approach it with a fixed belief rather than a probabilistic understanding. They assume that macroeconomic stress automatically benefits silver without considering how liquidity conditions, industrial demand, and policy responses interact. This is what happens when opinions override process. A disciplined approach requires stepping back and asking, where are we in the cycle, how leveraged is the system, and how might different scenarios play out? Markets are not moral. They don't reward conviction or punish doubt. They reward those who position themselves appropriately for uncertainty. The biggest mistakes happen when investors fall in love with a narrative and stop stress, testing it against history. Cycles don't announce themselves clearly at turning points. They end when excesses can no longer be sustained. Understanding cycles doesn't mean you always get the timing right. It means you avoid catastrophic mistakes. It helps you size positions properly, diversify intelligently, and remain flexible when conditions change. In the long run, avoiding big losses is far more important than chasing big wins. When you shift your mindset from opinions to patterns, from stories to cause and effect, you begin to see markets more clearly. You stop asking, "What do I believe?" and start asking, "What usually happens next?" That perspective doesn't eliminate risk, but it transforms how you manage it. and that difference is what separates speculation from intelligent investing. Investors are naturally drawn to opportunities that appear to offer protection and profit at the same time. Silver fits neatly into that psychological comfort zone. It feels familiar, tangible, and historically meaningful. Many people see it as a safer alternative to fiat currency and, at the same time, as an asset with significant upside potential. This dual perception is powerful, but it is also where the danger begins. The idea of silver as cheap gold is one of the most persistent narratives in markets. Investors compare prices and assume that because silver trades at a much lower nominal value than gold, it must be undervalued. They focus on historical ratios and expect a reversion that will deliver outsized gains. While such moves do happen at times, they are often driven by short-lived conditions rather than lasting fundamentals. When people anchor on price comparisons instead of underlying forces, they set themselves up for disappointment. What makes this especially risky is the illusion of safety. Because silver is a precious metal, investors mentally group it with gold, assuming it will behave similarly during periods of financial stress. This assumption leads people to underestimate volatility. Silver has historically been far more volatile than gold, experiencing sharper rallies but also deeper drawdowns. When investors expect stability and receive turbulence instead, emotional reactions tend to override rational decision-making. This false sense of security encourages poor positioning. Investors increase exposure beyond what they would normally consider prudent. Some concentrate too heavily, while others add leverage, believing that the downside is limited because silver is real money. In reality, the market does not care about labels. Price movements respond to liquidity, positioning, and macroeconomic conditions, not to how safe an asset feels. At the same time, the promise of explosive upside feeds greed. Stories circulate about past bull runs where silver multiplied in value over short periods. These examples are selectively remembered and frequently repeated, while long periods of underperformance are conveniently ignored. This creates unrealistic expectations. When returns fail to materialize quickly, investors either double down emotionally or exit at the worst possible time. Another layer of the trap lies in timing. Silver often performs best in narrow windows when monetary easing, rising inflation expectations, and strong industrial demand align. These windows are difficult to identify in advance and even harder to exit at the right moment. Most investors enter after the narrative becomes popular and leave after volatility turns against them. By then, the risk-reward profile has already deteriorated. There is also a tendency to treat silver as a hedge without examining what it actually hedges. While it can protect against certain inflationary scenarios, it may perform poorly in deflationary shocks or during aggressive tightening by central banks. Investors who expect silver to act as universal insurance are often surprised when it fails to deliver protection exactly when they need it most. The trap, ultimately, is not silver itself. It is the belief that an asset can be both obviously undervalued and broadly recognized as such, while still offering easy gains with limited risk. Markets are more competitive than that. When an idea becomes simple, popular, and emotionally satisfying, the potential for disappointment increases. Smart investing requires separating emotional appeal from structural reality. Silver can have a role in a diversified portfolio, but only when its risks are clearly understood and appropriately sized. When investors chase the comfort of perceived safety, combined with the excitement of imagined upside, they stop thinking in probabilities and start thinking in certainties. That shift in mindset, more than any price movement, is what turns opportunity into a trap. Silver occupies a unique and often misunderstood position in the global economy because it serves two very different purposes at the same time. On one hand, it is viewed as a monetary asset, a store of value that has been used for centuries. On the other hand, It is a critical industrial input, essential to manufacturing, technology, and energy production. This dual identity creates internal tension that many investors fail to fully appreciate, and that misunderstanding can lead to unexpected outcomes, especially during economic transitions. Unlike gold, which is primarily held for monetary and reserve purposes, a significant portion of silver demand comes from industrial use. It is used in electronics, solar panels, medical equipment, automobiles, and a wide range of other products. Because of this, silver's price is closely linked to the health of the global economy. When growth is strong and manufacturing activity expands, industrial demand supports silver prices. When growth slows or contracts, that demand weakens, sometimes abruptly. This is where investor expectations often clash with reality. During periods of economic uncertainty, investors may buy silver expecting it to behave like a defensive asset. However, if that uncertainty leads to reduced industrial activity, silver can come under pressure at the same time investors expect it to rise. This contradiction is not intuitive, but it is a direct result of silver's dual role. It does not fit neatly into a single category, and treating it as if it does can be costly. Liquidity conditions further complicate this dynamic. In late cycle environments, credit becomes tighter, borrowing costs rise, and companies reduce investment. Industrial users of silver scale back production, lowering physical demand. At the same time, financial markets often experience higher volatility, prompting investors to sell assets that are more sensitive to economic swings. Silver, caught between its monetary appeal and its industrial exposure, can be pulled downward from both sides. Another important factor is inventory and supply behavior. Industrial demand is typically more price sensitive than monetary demand. When economic conditions weaken, manufacturers look for ways to reduce costs, substitute materials, or draw down existing inventories. These actions can amplify downward pressure on silver prices. Investors who focus only on scarcity narratives or long-term supply constraints may overlook how quickly short-term demand can change. The energy transition adds another layer of complexity. Silver plays a role in renewable technologies, particularly solar energy. This has led to optimistic long-term projections and the belief that structural demand will inevitably drive prices higher. While these trends are real, they unfold over long periods and are subject to policy changes, technological innovation, and efficiency improvements. Short-term economic cycles can easily overpower long-term themes, especially during downturns. This dual nature also affects volatility. Because silver responds to both financial flows and industrial fundamentals, it tends to experience sharper price swings than assets with a single dominant driver. Investors expecting stability may find themselves exposed to rapid drawdowns, particularly during periods of economic stress. Volatility is not just a feature of silver, it is a consequence of its conflicting roles. Understanding this requires shifting from a simplistic view to a systems-based perspective. Silver is not just reacting to inflation expectations or currency movements. It is also reacting to factory output, global trade, capital expenditure, and technological demand. These forces do not always move in the same direction, and when they diverge, silver becomes unpredictable. The mistake many investors make is assuming that silver will always benefit from economic fear. In reality, fear can reduce industrial activity just as easily as it increases demand for hard assets. When that happens, silver's industrial side can dominate, leading to underperformance relative to expectations. Recognizing silver's dual identity does not mean avoiding it entirely. It means respecting its complexity. Only by understanding how monetary and industrial forces interact across different phases of the economic cycle can investors realistically assess silver's role, risks, and potential behavior. Leverage has a way of making people feel smarter during rising markets and more helpless during falling ones. In late cycle environments, When confidence is high and volatility has been relatively low, investors are especially tempted to use leverage to amplify returns. Silver, with its history of sharp price movements and its reputation for explosive upside, often becomes a preferred vehicle for this behavior. This combination, late cycle conditions and leveraged exposure, is where risk quietly becomes destructive. As cycles mature, the financial system becomes increasingly sensitive to shocks. Debt levels are higher, margins for error are thinner, and asset prices are more dependent on continued liquidity. When investors add leverage in this environment, they are not just increasing potential gains, they are compressing the range of outcomes in which they can survive. Small adverse price movements can have outsized consequences. Silver's natural volatility makes this especially dangerous. Compared to many other assets, silver tends to experience larger percentage swings over shorter periods. While this volatility attracts speculative capital, it also increases the probability of forced selling. Leverage does not fail gradually. It fails suddenly, often at the worst possible moment, when liquidity is scarce and prices are moving rapidly. When markets turn, they rarely do so in a calm and orderly fashion. Tightening financial conditions can trigger rapid repricing across assets. As volatility rises, margin requirements increase, and lenders become more cautious. Investors who rely on borrowed money are then forced to reduce positions, regardless of their long-term views. This mechanical selling pushes prices down further, creating a feedback loop that intensifies losses. What makes this particularly painful is that leverage removes optionality. Without leverage, investors can often wait through drawdowns, reassess conditions, and adjust their exposure rationally. With leverage, time disappears. Decisions are no longer driven by analysis but by necessity. The market dictates action, not the investor. Late cycle leverage is often justified by recent performance. When prices have been rising, risk feels manageable, and past volatility appears less threatening. This is a classic psychological error. Stability breeds instability. The longer markets remain calm, the more aggressively participants position themselves, increasing systemic fragility. Silver's price may appear controlled on the surface, while leverage quietly builds underneath. Another risk lies in correlation. During stressed environments, assets that normally behave differently can start moving together. Investors who believed leveraged silver positions would diversify their portfolios may discover that everything declines simultaneously. When correlations rise, leverage magnifies not just individual losses, but portfolio-wide drawdowns. There is also the issue of false precision. Leverage encourages investors to focus on short-term price levels, technical patterns, and entry points, believing they can manage risk through timing. In reality, macro-driven moves often overwhelm technical considerations. Policy shifts, liquidity changes, and economic surprises do not respect stop-losses in fast-moving markets. The harsh lesson is that being right on direction is not enough. Many investors correctly anticipate long-term trends, but still lose money because leverage prevents them from staying invested long enough to benefit. Survival, not prediction, is the first requirement of successful investing. This is why the most experienced investors treat leverage with extreme caution, especially late in the cycle. They understand that volatility is not risk by itself. Forced action is. Leverage transforms normal market fluctuations into existential threats. In silver, where price swings are already amplified, leverage turns a complex asset into an unforgiving one. When conditions tighten and volatility rises, the combination can erase capital quickly and permanently. Avoiding this outcome is not about pessimism. It is about respecting how markets behave under stress and recognizing that staying in the game is always more important than swinging for maximum returns. Investors often assume that holding silver provides protection across a wide range of economic outcomes. It is commonly viewed as a hedge against inflation, currency debasement, and financial instability. While silver can perform well in certain environments, its behavior is far more conditional than many expect. In both deflationary shocks and periods of tightening liquidity, silver has a history of underperforming relative to expectations, and sometimes relative to other defensive assets. In deflationary environments, the primary force at work is the contraction of demand and credit. Asset prices fall not because money loses value, but because cash becomes scarce and debt burdens grow heavier in real terms. In these periods, investors prioritize liquidity above all else. They sell assets to raise cash, repay obligations, and reduce risk. Silver, despite its status as a precious metal, is not immune to this dynamic. Because silver is partially driven by industrial demand, deflationary conditions can be especially damaging. As economic activity slows, factories reduce output, construction declines, and investment is postponed. This leads to a drop in physical demand for silver. At the same time, financial stress increases. The result is downward pressure from both real economy fundamentals and financial market behavior. Deflation also tends to strengthen the demand for cash and high-quality government bonds. These assets benefit directly from falling prices and rising real interest rates. Silver does not offer yield, and in deflation, the opportunity cost of holding non-yielding assets increases. Investors seeking safety often choose instruments that provide certainty and liquidity rather than volatility and price risk. In inflationary environments accompanied by tightening liquidity, silver faces a different but equally challenging set of conditions. While rising prices can support the appeal of hard assets, central banks typically respond by raising interest rates and withdrawing liquidity. These actions reduce speculative activity and compress asset valuations. Silver, which often attracts leveraged and momentum-driven investors, is particularly sensitive to this shift. Higher interest rates increase the cost of holding and financing positions in silver. As real yields rise, investors may rotate into assets that offer income or more stable inflation protection. Gold, for example, has historically held up better than silver in many tightening cycles because it is less exposed to industrial demand and speculative excess. Liquidity tightening also exposes positioning imbalances. When too many investors are on the same side of the trade, even a modest change in policy expectations can trigger rapid reversals. Silver's smaller market size relative to gold makes it more vulnerable to sharp price swings when capital flows reverse. What was once viewed as a hedge can quickly become a source of volatility. Another important factor is timing. Silver often performs best when inflation expectations are rising and monetary policy remains accommodative. This is a narrow window. Once policy shifts toward restraint, the supportive conditions fade. Investors who enter late, expecting inflation alone to drive prices higher, may find that tightening liquidity overwhelms that effect. The disappointment comes from mismatched expectations. Investors expect silver to behave like a pure inflation hedge or a crisis asset, but its performance depends on a specific alignment of macroeconomic forces. When those forces diverge, silver's weaknesses become more visible. Understanding this reality requires moving beyond simplistic labels. Silver is neither a guaranteed hedge nor a consistent safe haven. Its performance varies depending on whether inflation or deflation dominates, how central banks respond, and how industrial demand evolves. Treating it as a one-size-fits-all solution to macroeconomic risk leads to frustration and losses. The key lesson is that context matters. Silver can succeed in certain scenarios, but it can also disappoint in exactly the moments investors expect it to deliver. Recognizing these limitations is essential for realistic portfolio construction and effective risk management. Many investors believe that strong conviction is the key to success. They admire bold bets and clear opinions, often confusing confidence with competence. In reality, the greatest long-term advantage in investing does not come from being certain about a single outcome, but from being prepared for many possible outcomes. This is where balance becomes more powerful than conviction. Financial markets are complex systems influenced by countless interacting variables: economic growth, inflation, policy decisions, technological change, and human behavior. No individual can consistently predict how these forces will align. When investors concentrate their capital in a single asset or theme, they implicitly assume that their view of the future is correct. History shows that this assumption is rarely rewarded over time. A balanced portfolio acknowledges uncertainty rather than denying it. Instead of relying on one idea to work, it spreads risk across assets that respond differently to changing conditions. This approach does not eliminate losses, but it reduces the probability of catastrophic ones. Avoiding large drawdowns is critical because recovering from them requires disproportionately higher returns. A 50% loss, for example, requires a 100% gain just to break even. Conviction-based investing often leads to emotional attachment. When an investor identifies strongly with an asset or narrative, new information is filtered through that belief. Evidence that contradicts the thesis is dismissed, while supporting data is amplified. This confirmation bias increases risk precisely when flexibility is most needed. Balanced investors, by contrast, are more willing to adjust because their identity is not tied to a single position. Silver illustrates this principle clearly. Investors who treat silver as a defining bet may ignore signals that conditions are changing, such as tightening liquidity, slowing growth, or shifts in industrial demand. A balanced approach allows silver to play a role without dominating outcomes. If silver performs well, it contributes positively. If it underperforms, it does not threaten overall financial stability. Balance is not about diversification for its own sake. It is about thoughtful diversification based on how assets behave in different environments. Some assets perform well during growth, others during inflation, others during deflation or crisis. The goal is to construct a portfolio that can survive and adapt across cycles, not one that depends on a specific scenario unfolding. Another advantage of balance is psychological. Investors with diversified portfolios are less likely to panic during volatility. When one asset declines, others may provide stability or offset losses. This emotional stability allows for better decision making and reduces the likelihood of selling at the worst possible time. Emotional discipline is a hidden but crucial component of successful investing. Conviction also tends to encourage poor sizing decisions. When investors believe strongly in an idea, they often allocate too much capital to it. Even a correct thesis can result in failure if position size is too large relative to overall risk tolerance. Balanced portfolios enforce discipline by limiting exposure to any single outcome. The purpose of investing is not to prove intelligence or foresight. It is to compound wealth steadily over time. This requires staying invested, managing risk, and avoiding irreversible mistakes. Balance supports all three. It keeps investors in the game during difficult periods and positions them to benefit when conditions improve. Markets do not reward certainty, they reward resilience. A balanced approach recognizes that the future will surprise us, often in uncomfortable ways. By respecting uncertainty and spreading risk intelligently, investors increase their chances of long-term success. Conviction may feel powerful, but balance is what endures.